Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, but we're going to be comparing the current bear market to prior bear markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go to jump in. So the chart that you see here is essentially just sort of summarizing the prior bear markets that we've experienced in the S&P 500 since the Great Depression and that bear market that we saw from 1929 to 1932. And I wanted to spend some time to really digest the current bear market and where it currently is in relation to prior bear markets that we have experienced. So the first thing to consider is if you look at the chart how it is, it's very convoluted. It's hard to make any type of realistic or accurate assessments because it's hard to really see what's going on. But if you look closely, it's this sort of this like blue line. That's the current bear market that we're in. Okay, so I mean, up until this point, it does seem very similar to a lot of the bear markets, but why don't we go ahead and hide everything? And then we're going to pull up the current bear market. All right. And you'll remember all of these bear market rallies that we've had, and potentially we're in the start of another bear market rally. I want to go through and compare this bear market for the S&P to prior bear markets, more or less one at a time. Okay, so the first one we can look at is the one we had in 2020, and that was very, very brief. And the reason it was so brief was because, well, the Federal Reserve printed our way out of it. I mean, obviously it could have gone on for much longer if we had not, in fact, turned the money printers on, but that's not the way the history was told, right? The money printers came on and it bailed out the stock market. If you look at it, that's what it looked like. So what's interesting is this bear market, despite the fact that it's been much longer than what we experienced back in 2020, the drawdown from the all-time high in 2020 was actually a lot steeper than what we're currently seeing today. And so this bear market is not the price depreciation is one thing, but one of the things that is arguably more difficult to navigate is the time involved in order to sort of find a major bottom. Now, that was a very brief one. Let's go back and look at the one from the financial crisis in 2008. Okay, so this is a bear market, and I will warn you, there are some eerie similarities. I'll go ahead and pull it up while I talk. So I clicked on the wrong one. Go ahead and pull it up while I talk. This is the great financial crisis that we had back in 2008. And you can see that it actually, so far, it's not even that dissimilar from what we saw back then. Notably, fairly similar drawdowns, fairly similar bear market rallies. I mean, to some degree, you could argue it's almost uncanny that the similarity between, say, the current bear market and what we experienced back then. But if it were to continue to emulate what we saw back in 2007, 2009, you could still see some type of a rally, a bear market rally that, say, lasts for a month or so, and then perhaps starts to roll over in the November timeframe, and then December, and then into 2023, we sort of get that flush out, all going all the way down to whatever the final low will be. That would be if we were to follow what happened back then. Now, one thing to consider when thinking about sort of this potential path is, how could something like that play out? Does it make sense with the current narrative and the macro that we're experiencing today? Arguably, it wouldn't be that difficult to come up with a narrative to accompany something like this. It would just be that, the Fed's continuing to raise interest rates, the economy is still slowing down. We just saw job openings start to finally go down. So if the unemployment rate really starts to go up, then even by the time the Fed pivots, right, and we could eventually get that probably early next year. And I don't mean where they start cutting rates. I mean just where they hold them steady. If in fact that happens sometime over the next several months, let's say sometime in early 2023, then you could see a temporary relief. But the problem is, did the Fed go too far, right? Did they in fact go too far and push the economy into a recession? right? If you go back and look at prior, at some of the prior shorter bear markets, you'll see that there have been some where the Fed was able to manufacture or engineer a soft landing where the unemployment rate really didn't start to go back up. I do think the high inflation is going to sort of press the Fed's hand and not really being able to turn the money printer back on. But this is where we currently are. In terms of tracking this bear market compared to the one in 2007 and 2009. Now, if we go back and look at the dot-com bubble, we've compared, I mean, you guys know we talk about crypto all the time here. We've compared the dot-com bubble to crypto quite frequently throughout 2022. But in this one, we're just sort of gonna compare the S&P 500 and what it did during the dot-com bubble and sort of relate where we currently are. You can see it doesn't look as similar as the one from 2007, 2009 looked. Okay, you can see that there was a little bit of a divergence early on where from, 07, 08, we sort of still went up for a little bit to sort of go back up to almost like a double top. And then we ultimately rolled back over and continued on our descent. But what's interesting is that even in the dot-com era, we still had, several bear market rallies, but they still did not lead to new all-time highs. And this is one of the things that I think people should be aware of. Over the last decade, everyone's sort of just used to the Fed printing our way out of all of our issues, right? I mean, if anything bad happens, the Fed just turns the money printer on. If they're raising interest rates and the economy starts to look bad, they just cut rates really, really quickly to try to get things back on course. But this time, inflation is high. So I mean, it's something that the Fed hasn't had to deal with since really the early 1980s, and so certainly it is worthwhile to keep in the back of your head, in the back of your mind, what are some potential paths for this bear market to take, and these are risks that I think every investor needs to consider. Look, I mean, this entire year has been a fight between the bulls and the bears. And while the bulls do occasionally make up some ground, the bears continue to push the bulls back further and further every single time, right? Every single time the bears are able to make a little bit more progress. We have a bear market rally, but we don't put in a new high. It's just a lower high, and then we end up going down and putting in a lower low. And we've seen ourselves do that multiple times at this point. So I think it's important to realize that one of the important components to bear markets is not necessarily just the depreciation, but it's the time component involved. If we were to remove the current bear market and compare it to, say, what we experienced in 2020, this one was very easy to deal with because it went down so quickly, right? It went down so quickly, and then we came out of it so quickly, a V-shaped recovery with the Fed printing money. That's very unlike what we're currently seeing in the current bear market, right? It's just a slow and steady grind down. Now, you can feel, like I'm sure a lot of people here feel all the pain that 2022 has brought, okay? Now, I've said all year, cash is king. But regardless, I'm sure some way or another, this bear market has probably negatively affected you, right? Whether it's you're staring at the charts a lot, or you get worked up over every bear market rally and wondering if you should have YOLO'd in at the bottom or whatever the local bottom was. Or maybe you don't have cash in hand and you're happy on bear market rallies, but then you get pretty upset whenever we go down and put in a new low. Look, sometimes the time component is actually more difficult to navigate than just the price depreciation. Because if the price of if say the S&P 500 went ahead and bottomed wherever it was going to bottom tomorrow, then from that point we could, it would be fairly optimistic going forward because at least the bottom's behind us. And we could argue, I mean, there's always the argument that the bottom's already in, of course. But this gives you some perspective on where we currently are in the bear market compared to prior bear markets. Now, if you just simply go and compare the financial crisis with the dot-com bubble, you can see that the financial crisis did not last nearly as long as the dot-com bubble. The financial crisis was basically over in just over 500 days, whereas the one from the dot-com bubble, where we really saw things go down for over the span of a couple years, I mean, or even longer, this lasted 927 days. Okay? So not every bear market is the same, but when you compare the last two major bear markets that we had, not the one in 2020, but the two major ones before that, and you overlay the current bear market, you can see how the time component can be just as difficult, if not more challenging to deal with than the price appreciation. And in both of the last two major bear markets, you can see that in one case, there was still a couple hundred days to go. In another case, there was still, well over another year or more to go before the bottom was actually in. Now, why don't we continue on and compare it with what we saw back in the 1990s? And if you look at that, in the early 1990s, you can see this one was relatively short and sweet. Okay, we went down and then we came out of it in a relatively robust manner. If we go back to 87, sorry, I clicked on all of them. If we go back to 87 and compare that to where we currently are, you can see the price depreciation was a lot more swift, but it would have already been over. Okay, this was the bear market that we experienced in 87. We go back to 1980 to 1982 and compare what happened back then to where we are today. You can see this is where we are today. This is back in the early 80s. Yes, there was more price drawdown from where we would be currently in time. But the price drawdown that we experienced back then is actually not that different from what we just saw. The more pressing thing, or the more obvious thing, is that it just took a lot more time to ultimately get there. If we continue on and compare, say, the 70s, you can see that we still had plenty of chop left to go, and then we eventually did get another leg down into this bear market. So it sort of came all the way down, right? Maybe you could argue that this sort of move here is similar to this one. And then the market just went sideways for, maybe 6 months or something, and sort of just chopped around for a while. Didn't really get that interesting. And then we had another leg down. Continuing on, if we compare it with, say, the 68 to 1970, you can see in that case, the bear market lasted a good bit longer and still had further down to go. Still had plenty of bear market rallies the entire way. If we go look at 1966, we're actually more or less in line with what happened there, both in terms of price appreciation and in terms of the time it took. You go back and look at 61 to 62, it was shorter than the current bear market, but further down we went. The 56 and 57 bear market looks something like this. Looks kind of weird because we almost went back up and put in a new all-time high, but we didn't actually make it. We came all the way back down to evaluations. It's actually still around the current time, or the current depreciation from the all-time high in 2022. And I know this is a bit tedious, but I just want everyone to get a good idea of what we've experienced. This is the one from 46 to 49. This would be a fairly brutal market, because basically it would just leave the bulls and the bears right constantly, right? The bears will be right one month, the bulls will be right the next, and we would just sort of flip-flop around for years. I mean, this is years. I mean, you can see where we currently are. Is just a few hundred days in, almost 300 days. This lasted up to 1,100 days before the final bottom was in, and then we started a new rally, a new economic expansion. You have to remember that these choppy phases in the market, they can last a long time. With inflation still high, I wouldn't necessarily expect the market to immediately recover, but you have to be prepared for some type of prolonged choppy period. If you go back and look at, say, the 1937 to 1942 bear market, this is what it looks like. It was a fairly brutal grind. Arguably, you found the bottom within the first year or so, except if you ignore that final wick at the very end. Obviously, you could just say that this is more or less a double bottom for the most part, although we did go a bit lower a few years later. But this one lasted 1,800 days, right? Over 1,800 days. But arguably, once you got to this point, it was mostly just sideways for years before the market really started to come out of that. And then finally, we'll show the Great Depression, right? And listen, the Great Depression is certainly not my base case for comparing what we're currently seeing in the bear market, but it's always worthwhile to overlay just to get an idea of just how brutal it was. There are stories that I've heard that investors back then, that some of the investors back then, they would not ever touch stocks again after this, okay? And who could blame them, right? Who could blame them? Imagine if you were an investor and you started investing in, say, 1929 at the peak of the mania, and then we got into this prolonged bear market. Look how brutal it was, right? think about everything you've experienced in 2022 and the bear markets that have occurred and the bear market rallies that have occurred and how many times you've probably flip-flopped your stance on what you actually think is going to occur because you base it on say whatever the most recent rally is or whatever the most recent dump is. Think about all the emotions. I mean, this happens to everyone, right? It's not, I'm not trying to single anyone out. It happens to basically everyone. You are constantly questioning what your sort of your thesis is. I think this is only natural. I think all investors should constantly question what is their conviction on where things are headed and what's the counterpoint. But this chart, I mean, damn, right? Look at this chart. Look how brutal this market, the Great Depression was when you look at just how far down things went and over what time period it occurred, right? I mean, this would have been brutal. I mean, you would have been talking about another dump and then another bear market rally, another dump, another rally, another major dump down. By the way, this dump right here would have actually, I think, be on par with what we saw during the dot-com bubble. So if I overlay that, you can see that, yeah, right around here. That's sort of the price depreciation that the dot-com bubble saw. It took a lot longer for it to finally get there than it did in the Great Depression, but that's about as far down as the dot-com bubble went. And then if you go look at, say, the financial crisis, you can see where it ultimately ended. And we know how bad that was. I mean, a lot of people that watch this channel probably experienced that bear market. And you look at the financial crisis from 2008 and you compare it to the Great Depression, I mean, it was only like halfway over, right? If you compare the Great Financial Crisis to what happened during the Great Depression. So at the end of the day, I'm not trying to show these things to necessarily scare anyone and to trying to push any specific narrative. I just know that I know that there have to be prior investors that wish they would have thought about what the downside risk is. Not to say that it has to happen, right? There's always a chance that the Fed is able to engineer a soft landing, unemployment doesn't have to go up high, inflation comes back down quickly, and then they can get the money printers on sooner rather than later. Is that the most likely scenario? Obviously, you guys know my opinion. I think that's a fairly unlikely scenario that inflation comes down very quickly, but we could still see a prolonged period of say sideways movement. And if we follow what happened during the financial crisis a decade ago, you would still see several months of relatively inflated prices where we go through another series of higher lows and higher highs before it eventually starts to roll over as you get into the beginning, maybe like the end part of this year or early next year. And then you see that final, well, maybe not even final, but you would see a major shakeout in the stock market, which would essentially get you very close to the bottom if something like that were to actually play out. And I mean, we are coming back into earnings season, so we'll see where a lot of these companies stack up. Hopefully you guys enjoyed this video. Again, it's just from an academic perspective, not trying to push anything on you per se. I just want people to recognize, where we currently are and how it really lines up to a lot of these other bear markets that we've experienced. Some of the bear markets were relatively short, like in 87 and 1990. Some of them were relatively long, like in 2000 and 2007. Some of them were extremely long, like the one we experienced back in the late 1920s and early 1930s. That is the Great Depression. We're currently right here, okay? So that's the risk you take. There's always going to be a risk. I mean, no matter where you end up buying, there's always a risk that it goes lower. I just want you to be aware of what is the risk involved. And one way to look at that is to compare it to prior bear markets and try to get a better understanding of where things could go based on where things have previously been. If you guys like the content, make sure you subscribe. I really do appreciate you guys subscribing to the channel if you guys like the content. We also do have a Telegram channel for stocks. So if you want to check that out, it's called Into the Equityverse. You can find a link to that in the description below as well. And then also make sure you check out Into the Cryptoverse Premium at intothecryptoverse.com. You'll get access to this chart as well as a ton of other charts. I'm sure you see me talk about them all the time on the channel. But again, hopefully you enjoyed it. Subscribe, give the video a thumbs up. I'll see you guys next time. Bye.